Hello, my friends. Liberty Garden, coming to you from the house. I'm working on my studio today. Not my recording studio, but my actual office. Uh, and I decided to do a little comparison of purchasing gold versus investing money in the S&P 500. And I know there's a lot of gold bugs out there. I have a small amount of precious metals. Um, so let's put them to the test, see what's best. I'll give you several scenarios, including the one that I purchased and the two others. One scenario where you buy high, one scenario where you buy low, and one scenario where you buy in the middle. And I'll let you decide what kind of. I'll let you decide for yourselves if you think PMs are a good investment or not. So here we go. Okay. So I have this little spreadsheet. Now I could have done this with different calculators online and stuff like that, but I like to know where the numbers come. So I'm a little bit old school. I'll put a link to the spreadsheet on the description if you want to get it, then use it for yourself. I think it's pretty nifty. So in the first cell here, it's going to be my purchase date. So I bought my PMs on 4/18, 2011. The second cell is the current date. So that will be the date that when you're trying to sell it, the day you get a quote from AdMex or JM Bullion or whoever you call it to, the pawn shop or whatever, that will be the date. And I'm using these 2 days to calculate how much time I held the precious metals in my possession. That way I can calculate an interest formula, a future value interest formula. So here's years held. Basically, the difference between uh, March 8th, 2025 and April 18th, 2011 is 13 years, 0.89. So almost 14 years. The quantity of precious metals, 7. Now this is my purchase. So I'm going to get that one out of the way first. 2011 was a horrible year to buy precious metals, and I'll get into that a little later. Uh, the buy spot price per ounce at the time was my buy price was 1582. Okay, so basically I spent a total of $11,074. The sell spot. This is the quote that I got from uh, AppMex, and you can go to J and Bullion. I think J and Bullion has a little bit better price, but they don't include shipping. So AppMex includes shipping. So there you have it. I just went with AppMex because that's where I got them from originally. So there's no doubt that I'm in their system, so there's no questioning that the PMs are the ones that are returning, etc. So here's the sell spot the sell spot rate that I got was 2,859. Right, so I got it for 1582. Allergy season, folks. And I'm selling for 28.59. Well, that's the quote I got. I'm not selling, but that's the quote I got. So the total amount, if I sell it, would be $20,013. And if I subtract the original price, well, I get a profit of 89.39, right? So sell B10 minus B8, so B10 minus B8 gives me the profit. All fine and dandy. Looks like I've made out like a bandit. But in reality, if I calculate the interest rate over the course of these almost 14 years, I'm only getting 4.35 rate of return. Now, if you want to know how I got this formula, basically, here's the formula. I'm going to highlight right there. It's you got to know a little bit of algebra. I know you way around natural logs. I could have put it in a calculator, but I just wanted to make sure that I got it right. Uh, so basically, I'm setting like a future value formula where I'm saying, what amount at what interest rate gives me 20,000, right? So what amount is 11,000? At what rate of return is 11,000 going to give me $20,000 if I put it for $13.89 in a time investment, right? So basically, if I invest $11,000 for 13.89 years, what interest rate am I going to, what interest will that be that yields this sale price of 20,000? Okay, so you back into that number. Uh, so when I backed into this 435, and trust me, that's the right number, or check my math if you like. Uh, so that's how much this investment of $11,000 returned over the 13.89 years that I've held it. 4.35. Uh, on the here the next line, I have a the S&P average rate of return. How did I get that number? I just went to Google, uh, did the S&P rate of return since 2011, and I got 1391, which is basically uh, this the average annual rate of return, which includes reinvestment. To verify that the AI is not BSing me, like I said, I like to verify my numbers. I went to the mutual fund from Vanguard, BFIAX, and I look at the returns for that fund. So the BFIAX tracks the S&P 500. So basically, it's a mirror image of the S&P 500 in a mutual fund. So since 2011 to the end of 2024, the average return of this thing was 14.1. So really, look at the difference uh, between the rates of return. Let me see. Hold on, I might get this wrong here. Hold on a minute. Yeah, I'm sorry about that. Uh, this number I was messing around with this. Okay, 1391. Here we go. I'll put here 1391.91. Okay, so 1391 is my average rate of return since 2011. So I'm basically 19 basis points difference between what Vanguard says the real return was and what the Google AI says. And probably because this year has been a little rocky, and I'm not including these first 3 months of the year. This one ended in 2024. So I want to err on the side of caution and use the lower figure, 13.81. Okay. Hope you're following me still because I've made a lot of blunders. Um, so that said, if I compound this amount at 13.91% for almost 14 years, 13.89 years, I come up with a return, and here's the formula, you can check it, of $67,600, right? So, of course, there are taxes, long-term capital gains on this investment. So, in this next line here, I'm subtracting this number from the initial investment, so 67,000 minus 11,000, right? Times 0.85, which capital tax gains are only 15%. So I give Uncle Sam his cut, and I am left over with $48,000. Okay? So here's the two scenarios. On one scenario, if I had put that money to work in 2011, this $11,000 on 2011, on an S&P, on a mutual fund that tracks the S&P, I would have ended up with roughly $67,000 after taxes, $48,000. Whereas the scenario that I currently have on my hands is that I have made $8,000 with my gold, my physical gold. If I were to take it to the market today, I would net out an 89.39 profit, right? And the difference is a staggering $39,000, 108. Well, that's pretty sad, right? They put a little frowny face next to it here. Uh, that's that scenario. 2011 was a crappy year for PMs. Well, I mean, it was a crappy year to buy PMs. Look back at what happened that year. There's the spring of I think we had Libya losing Gaddafi. I think we had the I looked them up. I looked it up. I like to research the events of that year that drives the gold prices to go up or the PM's prices to go up. They usually correlate with instability around the world. I think we had Libya, we had the riots in the U.S., and we had the tsunami. For a while there, we had a different party in power, etc. For a while, the markets look a little unstable, and the price of gold reflected that. So that's that. Okay. So a couple of considerations here is that obviously capital gains on your investments, you got to account for those to have an apples to apples, which I did here. And despite that, I would have made out with $30,000, $39,000 more if I had put the money in a fund. Fees, etc. They're small. If you want to discount this percentage a little bit more, I'm already taking it down 20 basis points from what Vanguard says it is, so I'm not going to worry about that. And I'm also not trading it or anything. I'm just leaving it alone there, not touching it for 14 years. Uh, in the case of gold, you got to take into consideration shipping and insurance costs and storage. Uh, so, I mean, if you want to keep it at home, that's fine, but well, everything has risks, right? So you choose to you choose the place where you keep your gold, your precious metals. Uh, One of the benefits of gold is that gold is harder to sell and therefore more likely to stay in your possession. I mean, it's very easy to cash out on a mutual fund because you got a vacation coming up, you got a new car for this, that. But for gold, once you touch those coins, it's really hard to get rid of them. It's like like the precious on the Lord of the Rings. You don't want to get rid of it. uh, but anyway, nonetheless, I mean, people say that gold is a store of wealth, and look at it did what it needed to do, right? Uh, the CPI, the Consumer Price Index inflation, I believe it's about 3%. If you want to believe the number or not, that's up to you. It's ridiculous, but that's what it is, more or less. So gold is trending. If you had bought it at this time, gold would be giving you 4.35%. So it's keeping up with the Joneses or with inflation, and then some, a little more, give you a little extra, right? Now, great, but it does what it does, right? It preserves your wealth, although you could do a lot better in the market. There's one scenario. Uh, the sources here are AdMix, quote, macro trends, which I have open right here, and I'll show you in a minute, and the S&P average from Google returns, which I have right here, right? So those are my sources, and then this AI reply from Google, I also verified with the actual Vanguard returns for the fund, just to make sure that I wasn't getting some BS answer from the AI. Okay, so well, I mean, right? Lucky seven here, right? Well, luck is all about timing. Maybe the number of seven is lucky in some of the years, but in 2011 it was a dog, right? So let's look at different years. Let's say, for example, let's go back to our gold prices here. The historic price charts. You can look at macro trends. It's a real good website. And let's say that instead of buying your gold in 2011, like number that I did, see, that was the average price, 1573. My actual price was 1582, right? So man, I trust these numbers. So in let's say you see the trend here. You look at 99. I mean, I don't know if you guys are that old, but or you've been stacking since that long. But look at 98, 99. So let's take this 99, right? Let's say that in 1999 we bought some gold. Same amount of gold, 278.86. I'm just going to round it up to 279. Right. This is the average. This is the low. This is the high. I think what is this? The opening. Yeah, the high and the low. So we want to focus on these two columns here. So this one, the high of gold that year, 1999, was 326. The low was 252. So let's buy it at 278, 279, somewhere in the middle, right? So let's say we bought it at the average price on 1999. Let's see how we did. So let's say that we got it on April 18 of 1999. And we got it for, so now you notice my year changed. Now I've been holding it now for 25 years. Same 7 coins. And the spot price of that gold was 279. Much better numbers this time around. But we also don't forget to change. We also got to get what was the rate of return of the S&P since 1999. So let's see here. I'm just going to do the same question that I did the AI here. Since 2011, I'm say 1999. Okay. And Google tells me that in 1999, since 1999, the S&P has returned 8.22%. Okay. So let's plug the number in here, 8.22, and that assumes your dividend reinvestment, which is the normal, what an investment that you leave alone would do. I'm going to put 822 in there. So suddenly, you see that the gold rate of return is 940 now. Oh, it's not such a dog anymore. Actually, it's outpacing the S&P 500. See, 822 for the S&P, gold gives you about 120 basis points above the S&P. So let's look at how that would have done, right? So I have the 7 coins that I bought. So I invested $1,953, right? And at today's market price, I would have sold it for 20,013, net profiting 18,060. There it is. And my goals rate of return over the course of these 25, almost 26 years is 940. Here we have it. The average rate of return for the S&P is a 22. So effectively, uh, and then I got to take taxes away. So I would make $15,000, but then after Uncle Sam gets his cut, uh, I'm netting $11,000. So these two greens, once you're looking at this, what you need to look at. So basically, the difference between the 18,000 and this is 6,886. Basically, gold was a better investment if you had purchased it on 1999 and kept it. Now, I don't know about you. I don't know how many of you are old enough to have kept gold this long. Maybe there's some stackers out there that have kept gold this long, and they're doing okay. Uh, so you can see here, this is the important number to look at. Gold's rate of return, 9.40. So it's doing a lot better than inflation, right? The cost of inflation. So in the long run, very long run, gold is looking to be a good store of wealth, or at least on par, more or less, with the S&P, which is the stock market. However, the S&P has the problem of taxation, right? It's 15% taxes, so you got to pay. You got to pay what Caesar. Good thing Caesar takes fiat and not gold coins. But if you're selling American Eagles, you're not paying taxes on those. Not financial advice, not tax advice. That's what I was told by Admex. Okay, talk to your accountant. So there we have it, right? So in this scenario, from 1999, you would have had a profit of $6,886 above putting your money in the market. Okay, let's do one more scenario. And this time I'm going to say I want to do 2008. I'll show you why. Okay. And if you look at gold prices here, you go 99, you start seeing the trend going up, going up. This is the average for the year. So 99 is 278, 279, 272, 310. I'm surprised that it didn't go up higher with the Twin Towers crashing, with the 9/11. I'm surprised it didn't take a higher jump. Uh, Here we go to 3, to 4, 9. So along comes 2008. You all know what happened in 2008. We don't need to. But we had a certain individual come to power. or win the election towards the end of 2008. And the average is 872, but the high is 1,023, and the low is 692. Right? We all knew McCain was going to lose that election, and it was so. So I'm going to pick 2008. Right? That was the last good year for gold. Let's say that. After that, it just started going up and up and up and up and up. So you're trying to, right? So 872. So let's just put 872 on this amount here. So now we're gonna go 2008, and now I'm holding it for 16, almost 17 years. And what did I say it was? It's 872. So I'm going to put 872 here, my purchase price. So in 2008, 7 coins, my lucky seven would have cost me 6104 at $872. And if I were to sell it today, it would have gotten me the same amount, 20,000, but the net profit would have been $13,000 and 900, $13,909, $13,909, right? The rate of return goes down from, remember, on the last scenario was 9 point something, 9.4, now 7.28, right? Rate of return went down. And the S&P, let's look at the S&P. What was? We said the S&P was going to be 11.29. So let's put the 11.29 here. Okay, 11.29, the S&P. And then we have here then that at this rate, my S&P outperformed gold by about, what, 4 points. And let's see with taxes how it did. So my investment would have been, my S&P investment after taxes would have been $26,000 versus my gold investment, $13,000. Thus, I would be leaving $12,000 on the table if I purchase gold as opposed to putting it in the market. So in this case, at $872, the S&P would have outpaced the gold appreciation by $12,000 or 4 percentage points, right? So $12,000 is a good amount of money. It's a significant amount of money. Uh, Now, maybe next year the market takes a huge deuce, and if you're invested in the market, you can lose a lot. Or if you sell it because you get a kid about to go to college and you're forced to sell or something, maybe these numbers level out for you. But in the last 16 years, the S&P has been outperforming gold. Let's do one more scenario to illustrate a point I want to make. Let's do first of all here. I'm going to open a new tab. Okay, 2008. Let's do 2007. Let's see what happened. What happened here? Oh, it's a little bit of a different answer. Let's put it here. Let's see, 2007. Okay. Okay, 1053. Okay. Let's put here 1053. Okay, yeah. The reason I was doing 2007 because if you recall what happened in 2007, we had that whole mortgage crisis, right? I think it was 2007. The market took a deuce, and that was when all the bankers got bailed out. I was expecting the S&P to have returned a little less or to reflect a much lower number. It's not much, but it's not down by much. It's only 1053. So It's probably not worth it to put as an example. But anyway, I gave you three examples. One where you buy the gold real low, which is the only time where it came out ahead of the S&P 500, and that was if you held the gold for about 25 years. Uh, the other two examples is my example where I basically lost my shirt because I bought it in 2011, and this example where if you buy it on 2008, you don't lose your shirt, but you're still leaving $12,000 of money on the table. So anyway, I think this is a good example, uh, a good way to analyze your portfolio. And here you can instead of gold, you can put the price of silver you want to here. You just stick it in there. Just keep in mind that you have to adjust this date, right? And then you have to adjust this inflation number, the S&P average rate of return, sorry, to get the right numbers. So you got to basically take care of this date here, the amount of quantity that you're putting in there, and then your average S&P rate of return for that period. If you have any questions, put them in the comments. If you think I'm doing this wrong, by all means, let me know. I'm not an expert, and this is not financial advice by in any way, shape, or form. I'm just sharing what I do uh, on a March 8th rainy, cold day. So your mileage may vary, but this kind of gives you a good idea of where you want to put your money. And gold has its places. We saw it. It helps you diversify risk. If you have this, and in addition to this, you have a mutual fund, some stocks, and maybe other assets, land or rental properties, etc. That will be a whole part of your whole entire portfolio that you have to take into consideration. Uh, but alone, as if I was right now trying to pick between investing in gold and investing in the S&P 500, for me right now would be a no-brainer. I'd stick my money in the S&P 500. Sorry, folks, my mouth is a little dry. But anyway, let me know if you have any questions in the comments, or any comments, or any critiques, or anything. Like I said, this is new to me, but just trying to analyze this. Until next time, folks, I'll put a link to this spreadsheet on the description.